All right, welcome everyone. I'm super excited you're joining us for this explainer today. We are going to completely demystify the foundational principles of business finance. Now look, I know that staring at spreadsheets and hearing financial jargon can honestly feel like trying to read a foreign language, but we're going to translate all of that intimidating, complex stuff into really clear, actionable steps. You definitely do not need a finance degree to take control of your money. By the time we wrap this up, you're going to walk away with a solid structural blueprint to build some true financial confidence. Let's get right into it.
But first, I want to ask you a question, and it's a big one. Why do profitable businesses actually fail? You'd probably think it's because of, terrible marketing or a flawed product, right? Well, the reality is actually pretty surprising. The number one reason is poor cash flow. See, you can be making a profit on paper all day long, but if you don't have the actual cash sitting in the bank to pay your bills right now, your business is going under. It's that simple. It really proves one absolute truth. When it comes to business, cash flow is king. So, here is our game plan for today. We're going to start with building your financial foundation, then we'll decode essential statements, dive into active money management, explore capital and growth, and finally, we'll wrap up by looking at the modern tech stack. Okay, let's kick things off with Section 1, your financial foundation. So the absolute most crucial first step here is separating these two worlds. Business finance is not personal finance. One of the most common and honestly most dangerous mistakes beginners make is mixing their personal and company funds. You have to follow the very first golden rule of business finance: open separate bank accounts. Seriously, never, ever mix your business expenses with your personal ones. Keeping them completely distinct is quite literally the bedrock of your entire financial structure.
Next up, we really need to clear up a massive misconception that trips a lot of people up. Let's look at revenue versus profit. Revenue is just all the money coming in. Like if you sell $10,000 worth of stuff, boom, your revenue is $10,000. But profit is what's actually left over after you pay all your expenses. To really get a grip on this, you need to understand the four cornerstones of finance: income, expenses, assets, and liabilities. Those terms right there are the basic vocabulary you'll use for every single financial statement.
Moving right along to Section 2, decoding those essential financial statements. Think of these three core statements as the vital signs of your business, working side by side to measure your overall health. First up, you've got your profit and loss statement. This shows your income, your expenses, and your net profit over a specific period of time. Second is the balance sheet. This one is basically a snapshot of your business's net worth. It shows what you own, which are your assets, what you owe, your liabilities, plus your equity at one very specific moment in time. And finally, the cash flow statement. This is your reality check. It shows exactly where the cash is moving in and out in the real world, not just theoretically on a piece of paper.
Let's actually visualize the journey of just a single dollar traveling through your business. So you start out with your gross revenue, right? But almost immediately that gets chopped down by COGS, or the cost of goods sold. That's the direct cost of actually making your product or delivering your service. Then you've got to subtract your operating expenses. This also includes things like depreciation and amortization, which basically just reduce the value of your assets over time. After all that's taken out, what you're left with before taxes and interest is your operating profit. Really understanding how your revenue shrinks down into that operating profit is absolutely vital.
Which brings us to Section 3, active money management rules.
Active money management always starts with a rock-solid business budget. And to build one, you have to list out your income sources and carefully allocate your expected costs. That means you've got to distinguish between fixed and variable costs. Fixed costs are the ones that don't budge, like your monthly rent. Variable costs, on the other hand, well, they fluctuate depending on how much business you're actually doing, like buying raw materials. Tracking these accurately is the only way to ensure that every single dollar is accounted for. Once you're actively tracking those costs, you're hunting for a really big strategic milestone, the break-even point. This is the exact moment when your revenue finally covers all of your expenses. You're not exactly making money yet, but hey, you aren't losing it either. Knowing this number is critical. And because getting to that break-even point can be a pretty bumpy, unpredictable ride, maintaining a business emergency fund is essential. Unpredictable events are gonna happen, for sure. And that emergency fund acts like a shield for your precious cash flow.
Now, if you're staring at your numbers and you're just not profitable yet, you really need to adopt this aggressive but completely necessary rule for beginners. If it doesn't make you money or save you money, cut it. Seriously, be ruthless. Efficient cost management is literally the fastest way to improve your profit margins and make sure your business survives the crazy ups and downs of any economy. Review your financials regularly and don't be afraid to trim the fat.
All right, let's shift gears to Section 4, Capital and Strategic Growth. So when it's time for capital acquisition, meaning you need money to grow, you generally have two distinct routes. There's debt financing, which is essentially borrowing money, like taking out a term loan where you have to pay interest. Then there's equity financing, which involves bringing in outside money from angel investors or venture capital, or just reinvesting your own retained earnings. You've got to tread carefully here, though. Over-relying on debt can totally choke your growth, and you really need to understand how compound interest works, because it can either work powerfully in your favor or disastrously against you. If you're trying to grow fast, you're going to hear a whole lot of startup jargon. Let's translate a really big one right now: burn rate. Very simply put, your burn rate is exactly how much cash you are spending every single month. Tracking this monthly cash outflow is non-negotiable, because if you don't know how fast your cash is burning away, you have absolutely no way to stay in control of your growth. And knowing your burn rate leads directly to this next concept: your runway. Your runway is exactly how many months your business can survive at your current spending rate before the bank account hits zero. Calculating this matters on day one. When you actually know your runway, you can negotiate from a place of power with investors. It gives you the breathing room to expand at the right pace without hitting the panic button and giving away way too much of your company's equity. So look, before you ever approach a lender or an investor for capital, you must fulfill 3 exact requirements. Number 1, build a rock-solid financial plan. Number 2, forecast your cash flow so you actually have a picture of what the future looks like. And number 3, always calculate your return on investment, or ROI. Whether you're spending cash on marketing, hiring a new team member, or opening a new location, you have to measure that potential performance properly before you go asking someone else to fund it. And finally, that brings us to Section 5, the modern finance tech stack. Imagine ditching all those manual, clunky spreadsheets and using a specialized digital toolkit instead. It's a game changer. You can handle your core accounting seamlessly with QuickBooks while processing global payments without a hitch with Stripe. Your team's receipts? They're tracked on autopilot with Expensify, while you monitor daily corporate spending on a Brex card. When payday rolls around, Gusto handles your payroll and compliance. And for that higher-level strategy we talked about, tools like Float help you forecast cash flow, Planful analyzes your budgets, Carta manages your investor equity, FreshBooks handles service invoicing, and Zero Projects tracks billable hours. By building a customized stack from tools like these, you're not just doing math anymore. You are setting yourself up to scale with absolute confidence. As we wrap up this explainer, I really want to hammer home the core thesis of all this information. Your business's survival depends on its financial health far, far more than it depends on a brilliant original idea or a clever marketing campaign. You have to cultivate a financially disciplined mindset. That means reviewing your numbers weekly, not just checking in when tax season rolls around. Consistently work on improving your financial literacy. Read the books, watch explainers like this one, take the online courses. Once you understand the system, you won't fear it. I'm going to leave you with a final, slightly provocative question to chew on. Mastering business finance isn't just about trying not to fail. You have to ask yourself, are you just running a business, or are you building wealth? Because once you truly understand your numbers, actively track them, and strategically act on them, you're no longer just surviving the day-to-day grind. You are actively building long-term sustainable wealth. Keep your numbers strong, and your business will be unstoppable.